Most Canadians think that registered retirement savings plan, that is RRSP, are a no-brainer because you can contribute, get a tax break and retire rich. But the truth is that there are some hidden traps that can cause those savings to be taxed and be penalized. Don't get me wrong, when you contribute into your RRSP, you can get a tax break. You can also retire rich. It all depends on how you use it. So these traps are what I'll be showing you in the next few minutes of this video, using real examples and exact numbers. So please stay to the end of this video because I'll be sharing what you can do and the steps you can follow to fix your RRSP starting from now. Hi everyone, if you're new here, my name is Comfort, and if you're new here, I'm an investor, and anywhere money is discussed, you can find me there. I have motivated so many people to start investing, and I hope to motivate you too. So let's start with a brief understanding of what RRSP is. RRSP is one of the tax sheltered accounts that was created by the Canadian government specifically to provide tax brackets to anyone that cares to use it. And as the name implies, it's for retirement basically. There are other tax sheltered accounts like the TFSA, FHSA, RRSP, together with RRSP. So with RRSP, there's a maximum amount of contribution you can contribute into your RRSP, which is referred to as deduction limits. And if you want to know your RRSP deduction limit, you can find that in your notice of assessment or in your My CRA account online. And any amount you contribute into your RRSP, you can claim a tax deduction on that amount during your tax filing. And how you make this contribution is by investing in stocks, in ETFs, in bonds, using your RRSP account. So basically, RRSP is an investment account. And when your investment grows, that is when you make gains on your investment, you don't pay taxes on the money. If you withdraw before your retirement, you will have to pay tax on it. Not only that, you are also required to deposit back the money into your RRSP account within a specific time, and if you don't, there's a penalty for that, and I'm going to discuss that later in this video. Now, tax deferrals with RRSP is powerful, but only if you use it correctly. Now, here are the traps. Trap number one is a tax bracket trap. That is when you time your withdrawals wrongly. These tax deferrals and tax deductions benefits of RRSP is when you are taxed at a high marginal tax rate now, and then you withdraw at a low tax marginal rate when you retire. And the trap here is that when you contribute into your RRSP and you are in a low tax bracket, and then you withdraw when your taxable income is high, this can cause you to pay more tax than what you save from your tax deductions. Let me give you an example. If you contribute, let's say $20,000 into your RRSP when your income tax marginal rate is, let's say, 20%, and at retirement you withdraw when your marginal rate is 40%, that is a trap, because the tax you saved when you contributed was $4,000 if you calculate it, and the tax you paid on withdrawal was $8,000. So basically, you lose $4,000 in tax position. So don't assume that RRSP always wins. I know I have mentioned investing in RRSP in my previous video, so I'm just taking my time to show you these traps so you can avoid them. Always consider your expected retirement tax rate before using RRSP. I will show you how tax-free savings account, that is TFSA, can fix this trap later in this video. Trap number two is over contributing and the penalties that comes with it. Just like other tax sheltered accounts, RRSP has a contribution limit, and you can find your exact contribution limit in your last notice of assessment or in your My CRA account online. There is a small lifetime over contribution allowance of $2,000, but beyond that, the CRA charges you 1% penalty per month on the excess amount you over contributed. This is not good because that 1% monthly compounds to 12.68% annually. And this destroys your investment return, which is about 8 to 10%. So don't over contribute. But if you accidentally over contribute, withdraw the excess immediately. Don't ignore it. Now, trap number three is withdrawals in RRSP. Your RRSP is not a checking account or an emergency fund, so withdrawals are taxable. And if you withdraw money before your retirement, you must repay the money you withdraw. You can withdraw funds under the home buyer plan to buy your first home or under the lifelong learning plan, but you are required to pay back the borrowed amount over a scheduled period of time to avoid penalties from the CRA. It is also important to note that your RRSP can be locked in. If that is your type of RRSP, you will generally not be allowed to withdraw any money from your RRSP account until your retirement. Just as the name implies, locked in. Your RRSP is mostly locked in when you are matching, with your company, when your company is contributing to your RRSP. But there are conditions to unlock it, but we're not going deep into that in this video. So it is best not to be withdrawing money often from your RRSP account. You can use your cash account, your savings account for such withdrawals. Trap number 4 is wrong asset allocation in your RRSP. What I mean by that is choosing the wrong, investment into your RRSP. Historically, stocks have outperformed bonds in terms of returns they generate for investors. So it is better to have those higher returns, stocks in your TFSA, not RRSP. If you have them in your RRSP, remember that you're going to be taxed when you withdraw from your RRSP, but no tax on withdrawal from TFSA. So that's it. And it's also best to hold US ETFs in your RRSP because it is more tax efficient. If you hold US ETFs in your TFSA, you will pay withholding tax on the dividends payouts of that ETF to the CRA. But if you really want to, bypass this withholding tax, you have to use what is called Norbot's Gambit to convert the US currency in your RRSP and then use it to buy the US ETF. Common mistakes that Canadian investors make is that think they can hold something like VFV in their RRSP. It can be easily bought with Canadian dollars. You can buy VFV with Canadian dollars and there's no need for exchange, but it doesn't work that way. I have made that mistake in the past when I started investing. If you want me to show you how you can use Norbot Gambit, please drop it in the comment section and I will do a full well-explained video on that. But please keep in mind that it is not worth your time to use a Norbot Gambit to do the currency conversion unless you're converting at least $10,000 because some rates are applied. You may also want to avoid holding high-cost mutual funds in your RRSP that charges you 2 to 3% annually because these charges will compound away your tax benefits. The next trap is by the end of the year you turn 71, you must convert your RRSP into RRIF, that is Registered Retirement Income Fund. If you do not convert it by the end of this deadline, the CRA will treat your entire RRSP balance, that is the money in your RRSP account, as taxable income for that year. And that is a significant tax bill. So please have that in mind. Conversion from RRSP to RRIF can be done anytime before your age 71. But the thing is that once this conversion is done, you are required to withdraw a minimum amount each year from that account. And that amount is calculated and determined using a specific formula. Now, these withdrawals from RRIF are considered as taxable income. It's important to plan your withdrawals to avoid pushing yourself into a high tax bracket because of the amount you withdraw. Because remember trap number 1 we discussed, that is the tax bracket trap. Because if when you contributed into your RRSP, you were in a low tax bracket, now in your retirement, withdrawing in high tax brackets and being taxed heavily on that money is a total money mistake. But if you expect your retirement marginal tax rate to be lower than your current rate when you are contributing into this RRSP, then RRSP often wins. On the flip side, if you expect your marginal tax rate to be same or higher, then using TFSA is a better option. At the end of this video, I'm going to be giving you a 5-step checklist that includes how to decide between RRSP and TFSA. Now, this is the one change that can save you the most tax. Put the right kind of investments in the right account. Think of it like packing groceries. Some food need the fridge, some need the counter, some need the freezer. Investment works that way. You don't just put any and all kinds of stock in one account. Put your long-term growth investments like stocks, ETFs, index funds, put them into accounts with low fees like the RRSP and TFSA, and your money grows faster because you keep most of the returns. You are not losing money to high fees every year. Some investments get taxed heavily every year, like your high interest savings, your GICs, your foreign dividends. So if you put them inside your TFSA or RRSP, you will avoid those yearly taxes, which saves you more money over time. So planning is everything. Now here is the 5-step checklist. RRSP are powerful but full of traps. Number 1 step checklist is tax bracket timing. Number 2 is over contributions. 3 is wrong assets allocation. Follow the 5-step plan, check fees and plan withdrawals. Please, if this video helps in any way, hit the like button and subscribe to my channel to help me grow this channel. Thank you all so much for watching and I will see you in my next one. Bye.